Over recent weeks, a number of you have asked me, is the US going into recession? The reason that you've asked me this question is because of the commentaries that have been around by financial journalists, which shows that inversion of the US yield curve is a signal for US recession. So what I want to do today is a how-to piece, how to look up the US yield curve for yourself on the Federal Reserve Economic Database, or FRED, and how you can come to your own decision from the yield curve as to whether or not the US is going into recession. The first step is to go to Google, which is everywhere and knows everything, and put in the words yield curve FRED. And that will take you to a page of the Federal Reserve Economic Database, and you will have 23 choices of the yield curve. The one you've got to pick is the second one, which will be shown, which is 10-year Treasury constant maturity minus 3-month Treasury constant maturity. Choose that one, and what you'll get is you'll see your first glimpse of the yield curve as the Federal Reserve likes to think about it. And it's a 5-year period showing the difference between 90-day Treasury bills and US 10-year bonds. Now, what you then do is you go to the top of that slide and you click Max. And where Max will take you is to the longest data series that we want, which is what we want to talk about today, which is 40 years of data of the shape of the yield curve, the difference between US 90-day Treasury bills and US 10-year bonds. Now, when you look at this chart, what you'll see is that the Federal Reserve has already shaded in for you the periods of recession in the US economy in the last 40 years. It's not the US Treasury that determines when the US is in recession. It's the National Bureau of Economic Research, which makes that decision and provides those dates of recessions. So those are the shaded grey areas which you should now see on the slide. What we're looking at is, as I say, the difference between 90-day Treasury bills and 10-year bonds. As that rises, what's actually happening is 10-year bond yields are going up relative to 90-day yields. And the reason that's happening is the US economy is going through a period of increasing real demand for capital because investment is increasing. Now, when the Federal Reserve thinks that after a couple of years of that happening, of that increasing real demand for capital, driving investment in the US economy, driving up long-term interest rates, after that's been going on for a period, the Fed will make the judgment that the US economy is running out of room to grow. That may be because inflation is beginning to rise, wages are beginning to rise rapidly. That kind of judgment is then made. So what then will happen is they will start put up short-term interest rates relative to where 10-year bond yields are. After a period, you'll get to a point where US 90-day Treasury bills are higher than 10-year bonds. When that happens, the yield curve inverts. The difference between the two falls down to the line below zero, and it's that point when the Federal Reserve has tightened to the point where it has choked off the flow of funds to new investment in the US economy. That's when the US goes into recession after a period after that. And so what you will see after these yield curves goes into negative territory, you will see a shaded area showing that a recession actually occurred. It's interesting that the shaded area on the chart, which tells us when the pandemic occurred, occurs after a period of an inverted yield curve. So what that tells us is that we were going to have a recession in the US economy anyway, except it would have been much more shallow and longer lasting than was the actual event which fell upon the US economy because of the shutdown because of the pandemic. But what we can see from the chart is that at the moment, long-term interest rates are rising relative to short-term interest rates, and the yield curve is becoming increasingly positive. That means investment is increasing in the US economy, and right now, a recession for the US economy is nowhere near in sight.